Hey guys, Dave Keller here from Market Misbehavior. Wanted to share a quick story from yesterday morning. I was with my daughter eating breakfast, and she was had been talking to some of her friends at school. She's 11, and she'd been talking to some of her friends at school about what their fathers did, what their parents did for work. And she was trying to explain what I did, and so she asked me, "And what is it you do again, Daddy?" So kind of explained how I think about investor behavior, and I look at charts to sort of quantify what they're thinking. I tried to make it as simple as possible. She kind of listened and patiently for a while, and then she said, "So you're like a weatherman for the markets?" And I was like, "Yeah, pretty much. That's what I do." And the parallels between what a weatherman is trying to do, a weather person is trying to do, use models and understand and predict the future with some sort of consistency and anticipate how conditions are going to change, but with an expectation or an understanding that it is a very flawed and imperfect process, but you're doing the best you can. You're betting on probabilities based on what models and trends will tell you. I found it was a perfect parallel for what we do. And weather people have a purpose because they're that predictive value of trying to get close to where we're going to be is meaningful, right? It helps us understand things. So um, it struck me when she described it, though, was that I explained in great detail all the different things that I did and all the different inputs I use and how I thought about it. But she simplified it to, "So you're a weatherman for the markets." And that simplification made a ton of sense to me. We love to overcomplicate things in the financial industry, and especially as investors, whether you're running tons of money or a small personal account, we love to complicate the process. And we feel that the more complicated we can make it, the more rigorous, the more detailed it is, then the more rigorous, the more valid it is. And that's not always the case, right? A lot of times complexity can just add confusion. And so in a lot of ways, simplicity is a much better way to go. And what I love about charts is they tell simple stories. They boil down all of the market psychology, all of the fear and the greed, all of the emotions into very simple to understand, simple to visualize, simple to reflect on patterns and trends. I tweeted out a quote, one of my favorite quotes from Peter Lynch, and I enjoyed meeting him and talking with him a number of times. And he always said that, never invest in an idea you can't illustrate with a crayon. And another mentor of mine, John Mendelson, is a legendary technical analyst, used to come in and tell us, "I love trends that I don't need my glasses to see." And so, seeing big inflection points, big reversals, big turns, big trend lines, jumped out. And that simplicity of it was so meaningful. Another mentor of mine, Jeff Weiss, who's a fantastic technical analyst and a fascinating guy to talk to, he always would wait for daily and weekly closes, right? When you're looking at charts, don't react to the short-term stuff. He would draw these big trend lines and wait for a weekly or a monthly close, wait for it to actually violate that line at the end of the week or at the end of the month. And what that does is it makes you not worry too much about some of the short-term fluctuations, some of the noise in the markets, and just wait for the long-term patterns. When I was at Fidelity, one of my favorite parts about being in the chart room was when I would get a group of people through there and they'd be looking at these wall-sized paper charts, they would often take a step back and just sort of reflect on the long-term trends, the long-term perspective. And it's funny, as I'm looking at charts now on a smaller TV monitor, I feel myself at times like, kind of peering in and getting closer and really getting into the weeds and looking at the short-term fluctuations. And I have to remember that the value of looking at things on a large scale and from a big picture perspective, the 30,000 foot view can be so helpful because it's so easy to get sucked into the short term. So what are three quick ways that you can keep it simple in your own process? The first one is, as I mentioned, if you're a technically oriented investor or trader or a technical analyst, at times think about the weekly and the monthly closes as a more meaningful starting point or stopping point to your analysis, as opposed to looking at movements during the day, during the week. A lot of times there will be movement. If you look at the S&P 500 right now, we fluctuated a lot, but in a couple weeks, we really haven't gone anywhere directionally. And by focusing just on the weekly closes, and again, not to substitute what you're doing elsewhere, but maybe to augment it or to clarify it, think about just the meaningful ends to a week is one of the most important things I can see, because all the movements during the week will happen, but you'll focus in on one closing price. And no matter what happened from point A to point B, that is the direction the market has gone from Friday close to Friday close. So the first thing is look at longer term closing prices and wait for that to confirm what you might be seeing during the week. The second thing is to treat market commentary, to treat things you read, especially more short-term stuff, treat it as a drinking fountain and not as a fire hose. It's funny, we just moved recently, a couple years ago, from Boston, where they called the drinking fountain bubbler. And actually, what you call a drinking fountain can be very telling about what part of the U.S. If you're American, we call it different things: water fountain, drinking fountain, bubbler. So depending on what you call it, I could tell you pretty quick what part of the U.S. you probably grew up in. But anyways, we call it the drinking fountain here in Northeast Ohio. And you need to treat your market commentary and market awareness like that, right? You don't need to be grabbing every single thing you see. And the problem right now is there's a lot of clickbaity, short-term oriented, headline-driven content. And again, the best thing you can do is look at more long-form, timeless investing wisdom, as opposed to looking at short-term fluctuations and trying to draw broader conclusions from that. But in the age of the internet and social media and blogging and all of that, we're often sucked into that short-termism. So treat your market commentary, what you're reading externally from your own process, as a drinking fountain, not as a fire hose. The third thing is to stick to routines versus reinventing yourself. And what I mean is this. What I have found at times in my life is I have fallen victim to trying to reinvent myself every day. So I'm always looking at my routine, always trying to tweak it, always trying to improve it. I always have a new planner. My wife will laugh immensely when I show her this video, because she always laughs at how I always have some new idea of how I can organize things, how I can track my to-dos, how I can plan things strategically, how I want my office set up. I'll move things from one office to another. I'll set up monitors a different way. And I'm always trying to overcomplicate, how I'm organized. I'm always trying to improve it. And what she often reminds me is, all right, that's fine. You've done something new. Stick with that for a month, right? 30 days, just do that new routine, and then let's revisit it. And so what happens is, as investors, especially with all the inputs you could get, a lot of times you'll treat it as a daily opportunity to reinvent yourself, always looking for something new, some new headline. Okay, great. Who's that? Okay, I want to follow them. But sometimes what you need to do is just stick to a routine. If you have a good routine for understanding the markets, for tracking your own behavioral patterns, for tracking your trades and your investing game plan, for revisiting your positions, stick with that for a period of time. Don't feel like you need to keep reinventing it every day, every week. Stick with it for 30 days, and then make a point of thoughtfully go back and review and reevaluate, and potentially to reinvent. But if you're always trying to improve, if you're always moving, then it's hard to really gauge your progress and understand where there might be weaknesses in what you're doing. It can go maybe too far down the wrong path. So my 3 suggestions: number 1, stick to longer term closing prices if you're more chart oriented, to try and get away from some of the short term noise. The second thing, treat what you're reading, especially outside of your own investment process, your own analytical process, treat that as a drinking fountain, not as a fire hose. And finally, stick to routines for a period of time, and then write down in your calendar a time that you're going to thoughtfully go back and evaluate, potentially reinvent what you're doing. If this sort of thinking on process and investor behavior is of interest to you, I hope you'll check out my blog, marketmisbehavior.com. This is Dave Keller. Thanks so much, as always, for watching.